So the next module I'm going to cover is not actually covered as detail oriented in your book, but it is important for you to understand and to absorb this information in terms of what is a cash system and what is an accrual system of accounting. Now, we talked the basics of it. And like I said, under a cash system, whenever cash is spent, we record an expense. Whenever cash is received, we record a revenue. Now, that's a little simplified, and it's actually called the strict cash basis of accounting. The accrual system is on the other end of the spectrum, and that's when we use the revenue recognition principle and the matching principle in order to allow the recognition of expenses and revenues to deviate from a cash basis. When we allow that to happen, we can record economic transactions when they happen in real time versus when cash is exchanged. And so that makes us able to more accurately report items. Now, there's one system between the two that is allowable under GAAP, and I referenced this briefly in lecture, which is called the modified cash basis. And it is allowable under GAAP under certain circumstances that we'll talk about, but it's typically going to only be applied by smaller-based firms and by firms without inventory, because those are the two criteria. So, which is better, theoretically? The first question that comes into your mind is, well, which one should I do? And there's just no should. Like so many questions that are good questions, it doesn't have a concrete answer. It depends on the situation. The size and nature of the company. Does the company own a substantial amount of assets? Does it employ a substantial amount of full-time workers? How does it finance its operations, right? So the answers to a lot of these questions will determine whether the cash or an accrual system would be better. And I'll let you kind of think about that as we discuss what's going on, right? And I'll ask that again in class. Again, what is the purpose of assessing the company's profits and the goals of our analysis? Are you the treasurer for an organization? Do a cash basis, a strict cash basis. You're probably not going to have a lot of assets. You're probably just going to be wanting to report the funded nature of your organization, whether you have money to spend. You're not going to need a whole lot of accrual analysis, right? And so the answers to these questions can help us really determine which one's going to be better for you. Does the FASB think one style is better? Now, U.S. GAAP requires that the balance sheet and the income statement be presented in accordance with accrual accounting, with a small exception of modified cash basis. And we'll talk about that in a second. It does also require a statement of cash flows. And so the FASB actually makes us do both, a balance sheet and an income statement, which are both on accrual basis accounting measures, and a statement of cash flows, which is clearly a cash basis statement. So there is no official guidance that tells us which one is best. And the thing I can tell you is that both cash and accrual bases can offer unique and interesting perspectives into how a business is functioning and where we're going to go. And we'll talk about this more in chapter 4 when we talk about the income statement in greater detail and the statement of cash flows in greater detail. And truthfully, one statement on its own will ignore some pieces of information that the other statement can tell us. And so it's never just a one or other sort of approach, right? Two types of cash basis accounting, as I said. There's a strict method and a modified method. A strict cash basis means that, again, anytime I spend money, I have an expense. Anytime I receive money, I have a revenue. So you have a whopping 3 accounts. Now you might have 4. So, maybe I say 3 accounts. You could have really 4 because your net cash flow, I suppose you could call it capital, that you didn't spend. But really you have cash in, revenues, cash out, expenses. When you close those revenues and expenses, you could close them to an overall retained capital account of some sort that would be similar to retained earnings. But cash, revenue, expense, and that account would be the only ones you would have. Under a strict cash basis, you would follow the following convention. A debit to cash is a credit to revenue. A credit to cash is accompanied to a debit to an expense account. So even when we receive a loan, the strict cash basis would record this receipt of the loan as a debit to cash, right? Because we got money from the loan. We wouldn't credit a liability. We would just get a revenue, right? There's no link to the fact that we now have an obligation to pay this money back. Likewise, when money's spent, let's say on office equipment, we spent money, we credit cash, we would debit an expense, and we don't get to show an asset. And so strict cash basis records no assets other than cash and no obligations, period. Like I said, the best you can do is having a cash account, having an expense account, having a revenue account. And then if you were going to close expenses and revenues, like I said, you would have some sort of a capital account that would represent your retained money in the business over time. So clearly, you can see that there's some missing pieces of information. Who would use this oversimplified system? A very small company with few, if any, employees who rents rather than owns any substantial operating assets, right? Think of your kid's lemonade stand, Girl Scouts selling their cookies, right? Something very small. You don't want to use this if you have any substantial business. And seeing that not every business endeavor is a multi-million-dollar exercise, smaller businesses, even then that will probably require some amount of money or some system that can record things a little bit more sophisticated. The modified cash basis of accounting, this is when you'll come in to this type of system, right? You're more inclined to run into this outside of a toddler entrepreneurial effort, i.e. a lemonade stand. The modified cash basis system runs on the same principles of recognizing cash receipts as revenues, cash disbursements as expenses, but with a notable exception. Okay. Any cash spent on long-term operating assets no longer classified as an expense, but classified as a debit to the operating asset and a credit to cash. Any cash received based on a long-term financial liability or a long-term operating obligation is classified as debit to a cash or expense and a credit to the liability account. So here we record long-term assets and liabilities. Now, anything on a current asset is still going to be classified as if it were under a strict cash basis system. So we wouldn't have prepaid insurance, advances on employees' salaries, accounts receivable, and current liabilities that have to be paid in cash are not accrued. So again, strict cash basis, we spend money, it goes out the door, we record an expense. So we wouldn't have accounts payable, compensation payable, other sorts of short-term liabilities. So the basic rule of thumb is going to be that the long-term assets and long-term liabilities are recognized as they would be under an accrual system and accrued with the associated cash flows, but current assets and current liabilities are still ignored when cash actually exchanges hands. Now, when can we use the modified cash basis system? When can we not? I said that there's a couple of rules about that. One is that you have to have a relatively small amount of net assets. I believe it's 5 million. Remember, net assets being assets minus liabilities has to be less than or equal to $5 million. You can also have no inventory. So you have to be a service-based firm. And again, the inventory idea is that, sorry, my dog keeps walking in and out of this room, driving me crazy. The idea behind the inventory is that inventory is such a substantial current asset for firms that have it, it really needs to be recorded. So if you have inventory of any type, it really needs to be, you're required to do accrual system accounting. Okay. So let's look at a few types of common transactions and discuss how each system would handle the bookkeeping. I'm not going to go through all of these, right? What you need to remember and read through it yourself, please, by all means, do so. We'll talk about them a little bit in class, but I don't want to spend video time reading something to you. Look at each, think about how it would be recorded. Remember that on strict cash basis, we just have a cash, an expense, and a revenue account, and maybe a capital account. We expand this under the modified cash basis system to have cash, expense, revenue, capital, and long-term assets and long-term liabilities. And then the accrual basis is what you've always learned, that you have access to current, long-term, both assets, liabilities, cash, expenses, revenues, retained earnings, right? It really starts to develop an appreciation for the accrual basis of the system that we have. So I do want to walk through an example of 3 ways of reporting the same transactions. I have Audrey accrual, strict cash Sally, and modified cash Molly. They're each opening a merchandise venture. Unsurprisingly, Audrey has decided to use an accrual basis system. Sally has chosen strict cash, and Molly is the modified lady. So during the year, their businesses had the exact same transactions. Right? Investors invested $60,000 of their personal savings in their companies. So in the case of strict cash Sally, right, $60,000 becomes a revenue. Modified cash Molly, $60,000 gets to be a capital account. In the case of accrual Audrey, $60,000 also a capital account. Purchase $5,000 for equipment, expected life of 5 years, no salvage. This is a long-term asset. So Audrey, the accrual, the modified, are both going to record this as equipment on their balance sheet. Now, strict cash cannot. It's an expense. Signed a 2-year-long rental agreement for an equipment warehouse. The rent was negotiated at $3,000 a month with the first and last month's rent due immediately. Okay, so in this case, right, how are we going to record this? Well, it would depend on who we're talking about, right? And we'll look at that a little bit more in detail. Purchased $7,000 of inventory, paying $5,000 on delivery, and signing a note to pay the remaining $2,000. Now, if she were filing under US GAAP, the modified cash could not even think about doing modified cash. They would have to be accrual based, but let's pretend that they're not actually having to register with the SEC or go under US GAAP. We're just, going to say the legalities out of there. But if we purchase $7,000 of inventory, pay $5,000 on delivery, and we sign a note that's going to be paid on 4/1/14, well, there's going to be a couple issues here, right? The strict cash system is going to only record a $5,000 expense. The modified cash system is going to record the $5,000 spent and not record the current liability of $2,000 that has to be paid in a month. At this date, the accrual system would record the $5,000 cash outflow, record inventory as well, and also record the payable that would be due, right? So again, there's a lot of information that gets missed under these other cash-based systems that gets recorded under an accrual system. Made cash sales totaling $12,000 on merchandise that the company cost the company $3,500. Also received advance orders for merchandise costing $2,000 that were shipped on March 28th, for which they'll receive a $7,000 payment on April 2nd, 2014. All right, so again, a lot of stuff moving here. The cash sales totaling $12,000, that would just be revenue on the strict cash and the modified cash basis. The fact that they cost the company $3,500 would be recorded under an accrual basis as cost of goods sold. We wouldn't record anything that has to do with this under the modified cash or the strict cash, because cost of goods sold is matching expenses when they've actually produced a revenue, whereas the modified cash and the strict cash have already recognized the cost of the inventory when they paid $5,000. We also received advanced orders. Well, those advanced orders, 2,000, it doesn't actually matter until we receive the payment for the strict cash and the modified cash basis, but under the accrual basis, we get to record a receivable. We paid employee wages of $5,000 for the first quarter. This would be recorded as an expense under all systems: cash, accrual, and strict. Employees earned retirement benefits of $1,500 for their services. Well, they earn $1,500 of retirement benefits for their services, but they're not going to be paid to retirement. That's a long-term liability. Therefore, the modified cash would record it, the accrual basis would record it, but because it's not actually being paid, the strict cash ignores it. I'm going to go through each of these in class just to make sure you understand which ones would be recorded under each system and how they would be recorded. But in the interest of just seeing the overall picture, I went ahead and produced a balance sheet, so to speak, for each one. Like, how can I most accurately report what's going on? So strict cash Sally is just going to have cash inflows and cash outflows, right? Ignores anything that isn't paid in cash. Profitability looks like 48,000. Modified cash Molly is going to be a little different, right? Look, now we have equipment, right? Now we have employee retirement payable. We also have a different amount of profit or loss, right? This net cash from operations is net income for the strict cash system. And I think I to discern it to year, the representative 3,000 a month, personal. Yeah, okay. So one thing I did ignore here that should be under modified cash Molly is a $3,000 prepaid for the final month of rent, but we'll ignore that for now. So modified cash gets some long-term assets. Notice I expressed it net of depreciation. Has that long-term liability. We have a capital account now that shows the initial investment of the owner. And the profit or loss is very different from what we saw here. We had net inflow of cash of 48,000. We have actually a loss expressed for the year of $8,750. Under the modified cash basis, we have that profit or loss. We didn't have it in the other one. Now let's look at an accrual basis. Notice we have a lot of current assets. We have prepaid rent for that last one. That's what I should have included on the other modified system. That's the last month's rent that was paid in advance. We have accounts payable. That's a current liability. We have that long-term liability. And now we have a capital and a different sort of profit because we recognize certain expenses and revenues without the receipt of cash. Right? So now we get a more accurate idea of the actual operations of the company. So if you were asked to evaluate the performance of this company, which system would you prefer to see, right? Which one would give you the most evidence to make a wise investment decision? Okay. And these are just the balance sheets that are going to be presented. Notice that the information set portrayed becomes progressively more detailed in order for us to really get a good idea of what's going on. The profit number becomes more accurate in the ability of the company's operations to generate money due to the inclusion of sales that have not been included as cash, due to the inclusion of expenses that will be paid in the future. And a lot of times under the strict cash basis, statements can be misleading, right? Strict cash Sally records the highest profit, 48,000, but a lot of that was invested by the owner herself. Right? So in order to really get a great idea of what's going on, we really need an accrual or a modified cash basis. And even the modified cash basis can be misleading if you have a substantial amount of current assets, especially inventory, in your firm. We're going to talk a lot more about this. This lecture does not lend itself so well to being done on camera without interaction. And so I'm going to go ahead and broach this topic in class on Wednesday, and we'll spend a good time talking about the different systems and what your concerns may be. All right.